Right now, Opendoor Technologies, trading under the ticker OPEN, is priced at $8.37, which is a significant jump of over 4.5% in today's trading session alone. Now, you might see that surge and think the market has finally bought into the iBuying dream, the idea of frictionless real estate transactions powered by algorithms. The expectation is that this company is on a clear path to disrupting a multi-trillion-dollar industry, and today's green candle is just another confirmation of that bright future. But the reality staring back at us from the numbers is far more complex and, frankly, more volatile than the simple narrative suggests. That impressive daily gain is happening on the back of truly staggering trading volume, already cresting 114 million shares. This isn't just quiet accumulation, it's a battlefield. It suggests a powerful tug-of-war between fervent believers and equally convinced skeptics. The very foundation of the bullish thesis is being tested in real time, and what most people are missing is the underlying instability this high-volume volatility reveals. The common ground is the belief that Opendoor is a technology company first and a real estate company second. The pitch is seductive. Use data and machine learning to make instant cash offers on homes, lightly renovate them, and flip them for a profit, all at scale. This narrative paints a picture of a sleek, modern disruptor taking on an antiquated industry of real estate agents and lengthy closing processes. Investors who buy into this see a company with a massive total addressable market and the potential for exponential growth, much like we've seen with other platform-based businesses. They look at the top-line revenue figures from past quarters and see validation. They see a future where selling your home is as easy as trading in a used car. Many might look at their trading accounts on platforms like Robinhood or Fidelity and see the green percentage next to OPEN and feel a sense of vindication. However, this is where we need to challenge that comfortable expectation. The reality is that Opendoor is fundamentally tethered to the deeply cyclical, capital-intensive, and interest rate-sensitive U.S. housing market. It's less of a pure tech play and more of a high-tech home flipper operating on razor-thin margins. The core of its business model requires an enormous amount of capital to purchase and hold housing inventory. This makes the company exceptionally vulnerable to macroeconomic headwinds. When interest rates rise, as they have been, the cost of borrowing for Opendoor increases, and the pool of potential home buyers for their inventory shrinks. A slight miscalculation in their pricing algorithm or an unexpected downturn in a specific regional housing market doesn't just hurt a spreadsheet, it results in tangible losses on physical assets that are expensive to hold. The recent surge in stock price, while exciting, masks the deep scars from the preceding housing market correction. The company was forced to aggressively mark down the value of its inventory, leading to substantial losses and raising serious questions about the viability of the iBuying model during a downturn. The current rally is less a sign of a solved business model and more a reflection of a market desperately seeking growth stories, latching on to any sign of stabilization in the housing sector. Sophisticated investors using platforms like interactive brokers are likely digging into the financials and seeing a company that, despite its technological prowess, is still struggling to find a consistent path to profitability. The tension between the tech company valuation multiples that bulls want to apply and the real estate holding company fundamentals that bears point to is at the heart of the stock's wild swings. Let's dissect the recent stock movement more granularly. Today's price action, with a high of $8.83 and a low of $7.92, shows a wide intraday trading range. That kind of volatility isn't typical of a stable, mature company. It's the hallmark of a stock driven by speculation and rapidly shifting sentiment. The volume we are seeing is multiples of its average, indicating that a significant news catalyst or a large institutional player is making moves. This could be a positive sign, perhaps a large fund like Fidelity or a major ETF from Schwab Intelligent Portfolios increasing its position. But it could equally be a short squeeze, where traders who bet against the stock are forced to buy back shares to cover their positions, artificially driving the price up. The reality is often a mix of both. We know from filings that institutional ownership is significant, with major players like Vanguard and BlackRock holding positions. Their decisions to buy or sell can move the needle dramatically. The key is to watch not just the price, but the volume and the nature of the institutional flow. Is it patient, long-term capital coming in, or is it fast-moving hedge fund activity? These are the questions that separate a sustainable rally from a fleeting sugar rush. Many self-investing individuals using SoFi Invest or similar platforms might be drawn in by the momentum, but without understanding these undercurrents, they are navigating treacherous waters. The stock's performance over the last year has been a roller coaster, from a 52-week low of just over 50 cents to a high of nearly $10. This isn't the chart of a company executing a flawless business plan. It's the chart of a company fighting for its life in a challenging market, with investor sentiment swinging wildly between hope and despair. So what does Opendoor actually do? At its core, the company provides a service known as iBuying, an instant buying. A homeowner can go to Opendoor's website, enter their address, and within a short period, receive a data-driven, all-cash offer for their home. If the seller accepts, Opendoor buys the property, performs any necessary light repairs or updates, and then lists it on the open market for sale. The company makes its revenue from the service fee it charges the seller and, ideally, from the appreciation in the home's value between the purchase and the sale. The goal is to streamline the incredibly complex and stressful process of selling a home, offering speed and certainty in exchange for a fee. This business model is a direct challenge to the traditional real estate brokerage system. In addition to its core iBuying service, Opendoor has expanded into ancillary services like mortgage, title, and escrow to capture more of the transaction value. Past performance and older reports paint a picture of rapid revenue growth during the housing boom. When home prices were appreciating consistently and demand was high, the model worked well. The company could acquire homes and sell them quickly for a profit. However, when the market turned, those same reports show how quickly the model could break. The company's earnings reports from the housing correction period revealed significant inventory write-offs and substantial net losses, forcing a strategic shift towards a more disciplined asset-light approach and a greater emphasis on partnerships. This history is crucial context for understanding the present. The company is not the same freewheeling growth machine it was a few years ago. It's a leaner, more cautious entity that has been humbled by the realities of the housing cycle. Looking toward the future, the outlook for Opendoor is a study of contrasts. The potential upside is still immense. The U.S. residential real estate market is one of the largest asset classes in the world. Capturing even a small fraction of that market would translate into massive revenue for Opendoor. The primary catalyst for the stock would be a sustained recovery in the U.S. housing market. If mortgage rates begin to decline and housing transaction volumes pick up, Opendoor's business would benefit immensely. Increased volume would allow them to leverage their technology and operational infrastructure more effectively, potentially leading to a clear and sustainable path to profitability. Another potential catalyst lies in their ability to continue refining their pricing and risk management algorithms. If they can prove that their technology gives them a genuine edge in accurately pricing homes and predicting market trends, it would go a long way toward convincing skeptical investors. Any announcements about new market expansions or successful integrations of their ancillary services could also provide a significant boost to the stock. Investing through a well-managed portfolio, perhaps using something like Schwab Intelligent Portfolios or a Fidelity brokerage account, might offer some buffer, but a direct investment in OPEN stock remains a high-risk, high-reward proposition. Tell me, what's your outlook on the U.S. housing market for the next 12 months? Comment below with whether you're bullish or bearish. The answer to that question is deeply intertwined with the future of Opendoor stock. In conclusion, the story of Opendoor Technologies is a classic case of expectation versus reality. The expectation is a smooth, technology-driven disruption of the massive real estate industry. The reality is a gritty, capital-intensive business that is highly sensitive to the unpredictable cycles of the housing cycle. Today's impressive stock surge, with the price at $8.37 and climbing, is not a simple validation of the bullish thesis. It is a reflection of the intense debate and high stakes surrounding the company's future. The incredible volume shows that for every buyer convinced of the long-term vision, there's a seller who is focused on the immediate risks of interest rates and inventory management. The true test for Opendoor will be its ability to prove that its technology can provide a durable competitive advantage across all phases of the real estate cycle, not just during the boom times. Until it can consistently generate profits and demonstrate resilience in the face of macroeconomic headwinds, its stock will likely remain a battleground, a volatile and fascinating symbol of the clash between technological ambition and the hard realities of the physical world. For those considering an investment online, whether through a platform like SoFi or a more traditional individual brokerage, understanding this deep-seated tension is absolutely critical. This is not a set-it-and-forget-it stock. It's a high-stakes bet on the future of real estate itself.